So students, fourth chapter about market competition. Now you studied there are four different types or major types of competition in the market. First is the perfect competition. Then you have monopolistic competition. Then you have oligopoly or oligopolistic competition you can call, and then you have monopoly. Now why I have written the competition in this sequence, because as you go from perfect competition towards monopoly, one thing happens, and that is the extent of competition significantly decreases. And in fact, in monopoly, under monopoly, there is a single seller. In fact, the word monopoly means the seller is alone to sell. In fact, then there is no competition or zero competition. Whereas in perfect competition, the extent of competition is the highest competition here, highest competition among sellers. And monopoly, no competition. As we move from perfect towards monopoly, we know that competition decreases. So in a monopolistic market, the competition will be lower than perfect competition, but it will be higher than oligopoly or monopoly. Alright. So competition decreases as we move, and due to decrease in competition, one thing fairly happens, and that is that the of goods and services price of goods and services increases. Alright. Now let's come to perfect competition. Many a time they ask you, and this is one favorite question of the ICI, that is, which competition do not exist in nature or practically, or which competition is simply an ideal construct. Ideal construct, it means something that is utopian. It means it is so perfect that it doesn't exist. It doesn't exist. So when something that doesn't exist, why do we have to study about it? I mean, this is a fair question. Why do we need to study about something that doesn't exist? The reason is, if you don't know about the perfect situation, you will never be able to figure out what is the level of imperfection. As I've told you, in physics you study about perfect machines, because if you don't know about perfect machine, a perfect machine is one in which input and output is the same and there is no wastage in production. Alright, in accounts you must have studied about normal losses in production. Everywhere normal losses will happen. The output will always be lower than the input that you're putting in. Alright, clear, the quantitative output will be lower. So that's very true, that's natural. Alright, but a machine which is perfect, there'll be no difference between input and output. So these kind of machines do not exist. It's a utopian machine. Alright, so why do we study about it? So that we can figure out the other machines, how imperfect they are. So it gives us a benchmark. Likewise, a perfect competition gives us a benchmark to figure out how other competitions are lacking in some way when it comes to competition. Alright, so that's why it does it. Then they ask a related question, that which type of market is very close to perfect competition. Now remember that there can be a market which is close to perfect competition, but they cannot be a market which is a perfectly competitive market. So the market which is close to a perfect competition are largely agriculture and perishable goods market, because the substitutes which are available there are very close, very close. You buy one tomato from Andhra, another tomato from Calcutta, from West Bengal, there'll be not much difference between it. But when you buy something else, there may be little more difference. They may be close substitute, but the difference will be more. So that's why we say agricultural goods market or perishable goods market is a market which is close to a perfect competition. Now the question is, why this market do not exist, right? Why this market do not exist? All right. So why it doesn't exist, that is the question that you have to answer. When you look at the characteristics of a perfect competition, when you look at the characteristics itself will make it clear that why it doesn't exist. First of all, we say that people have perfect knowledge about the market. When people have perfect knowledge, it means from the both sellers end and buyers end, everybody knows in and out of the market. The buyers know how many sellers are there, what is their cost of production, what is their pricing policy, and everything. The sellers know how what is the consumer preference, what is what is their living cost, what is their standard of living, everything. What is the change in preferences of the consumer, everything. That is not a possibility, right? So they can have knowledge about the market, but perfect knowledge about the market is again a utopian concept, as a perfect thing that doesn't exist. So perfect knowledge. Second, it says that goods which are sold are identical. If there are several hundred sellers and selling, so for example, this pen, every seller will be selling exact same pen. I mean, there will be no difference. So goods will be kind of a perfect substitute. Or we say that goods are very homogeneous. Now this is you can find a characteristic which is not found in any other competition, except you will find in case of pure oligopoly, but that's also a competition that do not exist. So hom homogeneous goods and services. It means, see, goods can be perfect substitute, goods can be close substitute, very close substitute, but never a perfect substitute. In chapter 2 we have studied about that perfect substitutes have infinite cross elasticity of demand, but at the same time I've told you several times over that perfect substitute do not exist in nature. It's not a possibility. Even in case of agricultural good, there will be some difference between that, between two breeds of tomato or two breeds of onion. All right, there will be some, the difference could be 0.2%, 0.3%, but the moment there is a difference, it is not considered a perfect substitute. It will be considered as a very close substitute. So identical goods, clear. Third, we say that there are no price discrimination. So remember, sometimes they ask you which is a market where only homogeneous goods are sold, there will be a perfect market. Now there will be no price discrimination. Remember, these characteristics, you try to cram it, you will forget it, but uh, if you understand, you'll never forget. You will find out the differences between different types of competition, and also some points which are similar in different types of competition. No price discrimination. For example, this is common to perfect competition and monopolistic competition, because in both these markets there are no price discrimination, and also in oligopolistic competition no price discrimination. So no price discrimination is only possible in monopoly, wherein the seller is alone. So what is the meaning of price discrimination? Price discrimination simply means that even though the same product is sold by any single seller, it will be sold at multiple different prices, or you can say two different prices to two different consumers. For example, if I am a seller, I am producing this pen, I will sell you this pen at rupees 10, and to somebody else at rupees 15, and yet to somebody else at rupees 20. This is price discrimination. See, if the cost of production is different in different places when wherein I'm manufacturing, and due to which if I'm selling at a higher price, that's not price discrimination, because I'm compelled to increase the price. But when I'm trying to take advantage of consumer, and despite the fact that my manufacturing cost and all the direct and indirect expenditures are same, still I'm selling at multiple different prices, that is price discrimination. So wherein any single seller is going to sell the exact same product at different prices to different consumers, depending on their taste, depending on their preferences, depending on their income, depending on the geographical demography or whatever. That doesn't happen in case of perfect competition. So there is no price discrimination, and the same seller will sell the same commodity to everyone, all right, in every market wherever he is producing and selling. So no price discrimination. Then we say that there are no barrier to entry, no barrier to entry or exit. It means the sellers can enter and exit the market at their own whims and fancies. They are not going to be affected by the decision made by other sellers. In fact, they will not be able to create, nobody will be able to create a price barrier. If there is a perfectly competitive market for any product, and if I am a new seller, if I want to enter that market, no seller will be able to stop my entry into that market. All right. So no barrier to entry. And why there is no barrier to entry? Remember, when there are so many sellers, who is going to stop my entry? Because if I'm entering the market, I'm going to affect every seller. Now, is it possible for every seller or thousands of sellers to come together to beat down one new seller entering the market? No, they cannot be. It's not possible for so many sellers to collude among themselves to kick out a new seller from the market. So I enter the market. If I'm able to, earn profit, I will stay. If I'm not able to earn profit, I will exit. My entry and exit will not be determined by other sellers in the market. So there is no barrier to entry. And then we say that firms are price takers and not price makers. Remember, this is a unique characteristic of a perfect competition wherein the firm is a price taker. In all the other competition, the firms are price maker. So firms are price taker. What do you mean by price taker? Sometimes they call it price taking firms are present in which type of competition it is a perfect competition. So when I say firms are price taker, it means when a new seller is trying to enter the market, he will have to sell at the exact same price which is charged by all other sellers. Now, how or why does it happen? Remember, perfect competition, let's for now understand, let's say if it hypothetically it exists, hypothetically, because in case of perfect competition everything is hypothetical because it doesn't exist. So let's say hypothetically our competition is there and it's moving towards a perfect competition, but any competition may start from a monopoly. So suppose a single seller enters the market. Suppose he is the one seller, sole seller enter the market. His cost of production is say rupees 100. He is selling the commodity at 300. Huge profit. Now if he is not able to stop the entry of other sellers, say two more sellers enter the market, and since you are producing perfectly competitive goods, it means the cost of production will also be mostly the same. So in order to capture the market, they will start selling at 250 maybe. And if these three are not able to collude, then 10 more sellers or 20 more sellers or 100 more sellers will enter the market. For them, the cost of production remains same and they start selling at 200. When they start selling at 200, the previous sellers will decrease the price to 190. By that time, 100 more sellers enter the market and they start selling at 150, which forces the remaining sellers, existing sellers, to decrease the price to 140. By that time, 200 more sellers enter the market and they start selling the product at say 120, which forces the other sellers to decrease the price to maybe 110. This way it will continue to go and more sellers enter the market and the market price will be beaten down. Now let's say the market price comes down to 100 rupees and 20 paisa or 100 rupees and 10 paisa. Now, when from this point onwards, if any seller enters the market, do you think it will be able to sell at 100 rupees? It means at cost, then why you're doing business? All right. If you have to produce at 100, sell at 100, there is no profit for you. So no. So it means now the sellers will have to take up the market price. It means everybody will have to enter the market at 100 rupees 0.20 paisa. Now, any new seller, if they try to decrease the price further, they will have to sell below cost. That is not a possibility. And if they try to sell above 100 rupees 20 paisa, then nobody will buy because perfectly competitive goods are being sold by all other sellers. Why will I pay even 10 paisa more to a seller when I can buy the exact same commodity from other sellers at a lower price? So the price becomes very sticky now. So from this point onwards, any new seller entering the market will have to sell at the prevailing market price. That's why we say that the firms are price takers and not price maker in a perfectly competitive market. So price taking firms only exist in a perfectly competitive market. All right, clear. Now we study about what will be the extent of profit for the firms. See, in a perfectly competitive market, a seller can produce any number of commodity. As far as they are earning profit, there is no problem at all. Alright. In fact, their profitability will be determined by how many units they are selling. If suppose the margin of profit is only 1 rupee, if I'm selling 1 lakh units, I will make 1 lakh rupees profit. If I'm selling 10 lakh units, I'll be making 10 lakh rupees profit. Alright, during a period of time. So I can only increase my profit by increasing the quantity of goods and services sold, not by changing the market price of the commodity. That's why I end up becoming a price taker. So when I'm forced to take up the price prevailing in the market, it means I can never earn abnormal profit. Alright, either in the short run or in the long run, I can never earn abnormal profit. So in a perfect competition, abnormal profit, or sometimes we call it as supernormal profit, can never be earned. Now remember, losses can happen in every competition. I've told you 10 times over in the previous sessions. Losses can happen in every type of competition, even in monopoly. Abnormal losses also can happen in every type of competition. But supernormal profit or abnormal profit will not happen in every competition. Alright. So the firm will be earning only normal profit and not abnormal or supernormal profit. They can incur obviously losses. Alright. Clear till this point? And what is the reason? See, you have to find a reason for everything. Because I am forced to take up the market price, I am not able to determine the price of my own product. That's why I'll never be able to exploit the consumer. And remember, the firms generate supernormal profit only through exploitation of consumers, mostly from exploitation of consumers, you can say. If the firms are not able to exploit the consumers, then they will never earn a supernormal profit. You see the telecom sector, go back 20 years. The companies like Vodafone, Airtel, they used to generate supernormal profit. Why? Because it was a kind of oligopoly and there was a collusion between them, and they were they know that consumers, if they want to have a mobile phone, they will go to these 4 5 sellers of services. So they used to exploit the consumers to the hilt. For incoming also they used to charge, for outgoing also, for roaming also, everything. There was no portability of numbers. So consumers exploited, and that's the reason they were able to generate so much of profit. But today, despite it's an oligopoly, but it has become a competitive oligopoly. So do you think any seller is in a position to exploit the consumers? No. So supernormal profit is gone now for them. All right. Now it comes to, now they ask you whether there is an advertisement cost, which is also sometimes known as selling cost, because these costs are incurred to increase the sales. All right. All right. So advertisement cost or selling cost, it is said that there are no advertisement cost incurred. No advertisement cost incurred in a perfectly competitive market. What is the reason behind it? The main reason behind is that everybody is selling a similar product. Two reasons. Everybody is selling a similar product, not similar only, but identical or homogeneous product. Advertisement or selling cost is usually incurred to tell the consumers that my product is better than the competitor's product. The sellers want to convey this idea to the consumer. Coca-Cola is better than Pepsi. But when there is no difference between Coca-Cola and Pepsi and consumers have the perfect knowledge about it, do you think they can be fooled by the advertisement? Alright. When people have perfect knowledge about the product, then there is no sense in spending any money on advertisement. Second reason is that already per unit of the product, the companies or the firms are earning wafer thin margin of profit. It's a hairline profit that they are earning. So can they afford to spend any amount of money on advertisement? That's why we say that there are no advertisement cost or selling costs incurred by the firm. All right, clear? No advertisement or selling cost. Then we say that the curve of the firm, perfectly competitive market, a demand curve for the firm, when I take this here price and this is quantity demanded, it is a straight line. Why it is a straight line? Because in a straight line or horizontal demand curve, the price remains fixed at this point. Since the firms are price taker and not price maker, they cannot determine the price. It means they cannot sell at this price, neither they, because if they try to sell at a higher price, then nobody will going to buy their product. and if they sell at a lower price, it means they have to sell below cost, and moreover the moment they lower the prices, other sellers will also lower the price. So there is no rationale in lowering the price. So price will be fixed at this point. The quantity that is sold by the sellers and the quantity demanded could be different. So that's why we say that there is a straight line demand curve. Another thing that we commonly ask about perfect competition is to distinguish between what is a perfect competition and what is a pure competition. So just remember, in a perfect competition and pure competition, the two major differences that in a perfect competition, it is assumed that there is perfect knowledge about the market. People have perfect knowledge. The sellers and the buyers have perfect knowledge about the market. Perfect knowledge about the market. And second is that there is absence of transportation cost. Absence of transportation cost. Now, don't you think this is unrealistic? Because without carriage inward and outward, without carriage inward, how will I get the raw material to convert into finished product? And once the finished product is made, without carriage outward, how will I be able to distribute my goods to the final consumers, to the market, where the market which is the link between the manufacturer and the consumers? So there is absence of transportation cost. This is very unrealistic. So in a perfect competition, these two assumptions are also made, but in a pure competition, it is not made. So pure competition, remember, again I am repeating, pure competition will have all the characteristics of a perfect competition, except these two assumptions are not made. It means it is not assumed that people have perfect knowledge about the market, and it is also not assumed that there is absence of transportation cost. It means there is a transportation cost in a pure competition. That's the difference you have to keep in mind, because very frequently they ask you what is the difference between a pure and a perfect competition. All right. Moreover, we say in a perfect competition there is free mobility of factor inputs. Free mobility of factor inputs. What are factor input? The raw material, the labor. All right, the raw material, the labor, the technology for manufacturing, everything. So free mobility of factor inputs, it means whatever is the factor input that goes in manufacturing any product is freely mobile, because every seller is producing the exact same commodity. These mobility of these factors are very easily available and very easily mobile in the industry. All right, now let's come to the uh, demand curve for this firm. All right, the demand curve for this firm, we say that if suppose this is the price, and remember price is also equals to AR always, because AR is TR by quantity, and when you divide total revenue by quantity, you will get the average price, which is nothing but the price. So this is the demand curve. All right, now why it is a horizontal demand curve? The fundamental reason why it is a horizontal demand curve, because the price is same, and due to the reason that the price is same, you will find that there is no difference between marginal revenue and average revenue. In all competition you will find there is a difference between average revenue and marginal revenue, but here there is no difference. And how I explain it through the table? You see, if I take the price here for any product, and if I take the quantity here, and I take total revenue here, marginal revenue here, and average revenue here. So price is same, rupees 10, let's consider it as 10, 10, 10, 10 and 10. If I say selling zero quantity, then everything will be zero. But if suppose I'm selling 1 unit or 2 unit or 3 unit or 4 unit, you will find what is the total revenue. 10 into 1 total revenue is 10, 10 into 2 total revenue is 20, 10 into 3 30, 10 into 4 40. TR equals to price into quantity. Now marginal revenue is change in TR by change in output. So here change in TR is how much? 10 minus 0 divided by 1 minus 0, 10 by 1 is 10. Then here TR is, just hold on, 20 minus 10, 10 divided by 2 minus 1, then again 10. Then here 30 minus 20 is 10, divided by 3 minus 2 is 10, 10 here as well. And if I calculate average revenue here, average revenue is TR by quantity. So here it will be 0. Then you have here 10 divided by 1 is 10, 20 divided by 2 is 10, 30 divided by 3 is 10, 40 divided by 4 is 10. So you will find that marginal revenue and average revenue is the same. Now here I've taken simple quantities. You can take any quantity, doesn't matter. You take 100, 200, 300, 400 or 500, 700, 1000, 10,000, doesn't matter. If the price is same, you'll always get the marginal and average revenue to be the same. So in fact, this curve, which is the demand curve, is also equal to the marginal revenue. All right, clear? That's why it's a straight line demand curve. Clear? I hope that's clear to you. Now let's understand the concept of equilibrium in a perfectly competitive market, where I found many students have some problem. Now remember, here you have to first determine what is the equilibrium for a market equilibrium. And then here equilibrium for the firm's equilibrium. On this side, I'm taking the equilibrium that is achieved by any particular single firm, and market equilibrium, it means how equilibrium of the market is determined when I consider the input and output, the output and the demand of the entire industry. All right, so you can call it as industry equilibrium as well, or equilibrium of the industry. Clear? Market or industry equilibrium. In chapter 2, we have seen the equilibrium of the industry will be determined at the point wherein the aggregate supply curve and aggregate demand curve, they will intersect with one another. So let's draw it. If suppose this is the price and this is the quantity, this is the supply curve, this is the demand curve. This is price and quantity. Now this is the price that the firms are taking. Alright, the firms are price taker. Why? Because every new firm entering the market will have to take up the prevailing market price. And this output is the total aggregate output of all the firms which are present in the entire industry. So if there are 10,000 firms present in the industry, when I collectively aggregate the output of all the firms together, that will be this quantity, which I have written here as Q. So the industry achieves its equilibrium wherein the demand and the supply curve, the aggregate demand curve and the aggregate supply curve, they intersect with one another. But how does a firm achieve its equilibrium? It means how will I achieve my equilibrium? Now equilibrium is not break even, remember. Alright, when I achieve equilibrium, when I say that my marginal revenue, what is marginal revenue? The revenue earned by selling one additional unit of any commodity. It means change in the total revenue divided by change in the quantity. Alright, that is the marginal revenue. And marginal cost is what is the additional cost that I incur when I produce one additional unit. For example, I have been producing 10,000 pen and my total cost is 10,000 rupees. Let's say I am producing now 11,000 pen. The total cost increases to 11,000. So what is the additional cost? That is 1,000. What is the additional output? That is 1,000. So it means marginal revenue will remain 1. Alright. So this along the y-axis, I'll consider first of all here, if I take into consideration. So this is the price that the firms are taking. So it means this line, horizontal line, cannot go up or it will come down because the firms are price taker. So this line will stick to this point. Alright. Now keeping this as reference point, the firms will have to produce significant amount of output in order to achieve the equilibrium, because there is always you can say an advantage in producing large scale of output because it decreases your average cost of production, right? So this is your marginal cost and marginal revenue both, if I consider this, right? Because when I'm drawing marginal cost from here, it will be determining marginal cost, and when I'm putting any point on marginal revenue, it will talk about marginal revenue. It will show marginal revenue. So this is your MR and AR, and this is also your price here. MR and MC. So now here, if you see, this is your marginal revenue, and this is your marginal cost. Marginal cost. This is considered as the point of equilibrium, because at this point, whatever unit I'm producing, additional unit, the production cost of that additional unit is equal to the revenue that I generate from selling that unit. I should not sell below this point, neither above this point. Why is it so? Let's say this, the price of any commodity is rupees 10. I have to sell this at 10 rupees only. Now if I'm, say for example, selling at this point, let's say I'm selling 500 units. What is my marginal cost here? Let's say my marginal cost is 3 rupees. It means to produce from 0 to 500, the additional cost that I've incurred is 3 rupees. Now, not total cost, additional cost. Now, what is the total, what is the marginal revenue is 10. What is the difference between MC and AR? 7 rupees. So what is the additional revenue that I'm generating? 500 into rupees 7. Additional revenue, not total revenue. Total revenue I'm generating is 500 into 10. Alright, clear? Because the market price is 10. But the cost is, additional cost is 500 into 3. So 1500. So 5000 minus 1500. 4500. So 5000, uh, 500 into 10, that is 5000. And here 5000 in 500 into 3, that is 1500. Clear? So what is the difference? Is 7 rupees. So 7 rupees, it means 3500 of extra revenue I'm generating over marginal cost. Now if I go beyond this point, let's say I produce 500 additional unit. It means a total at this point, let's say this, consider this point A. At point B, total unit produced is 1000, but additional unit produced is 500. So what happens to my marginal cost? It increases. It increases from 3 rupees to, let's say, 7 rupees. So additional cost of producing 500 additional unit is 500 into 7, 3500. But what is the additional revenue that I'm generating? 500 into 10, that is 5000. So what is the difference? 10 minus 7, that is 3. 3 into 500, that is 1500. So you see, the revenue is decreasing. The revenue is decreasing when I'm considering the aggregate, when I compare it with the marginal cost, but still it's a positive revenue that's coming into my pocket. So I should, that's why produce. Many people say, sir, marginal cost is increasing, why should you produce? No, marginal cost is increasing, but still it is lower than my marginal revenue. It means I am in a positive territory, so I should produce. Clear? Because I've also spent a lot of capital on on machineries. How will I be able to use the full potential of that machinery if I just stop production when the marginal cost is increasing? Marginal cost, when it increases, you do not end up production. Marginal cost is increasing, it is bad. You are going into a territory of diminishing return, but return is diminishing, it is not become negative. Understood? It does not become negative. So if I would have stopped at point A, I would have to be happy with only 3500 rupees. But if I would have gone to B and produced at that level, I would have generated 1500 additional rupee. So I should do that. Now let's say I go to point C and I produce 200 additional unit. Now the total unit is produced 1200 unit. Alright, additional unit produced is 200. Now the total marginal cost here, it is increasing to 9 rupee. Alright, because, and so to, when I find out an aggregate here, it will be 1800. But what is the marginal revenue? Still I'm getting a positive one. Marginal revenue is still positive. It is, so 200 into 1. So into 1, I'm getting 200, very less, but no problem at all. The revenue is positive. I'll go ahead and sell it. Now see, nobody can predict future. If you can predict future, you will stop below at the point wherein the marginal revenue, marginal cost and marginal revenue do not become equal, but you cannot predict future. So what you will do, you will produce maybe 100 more units, but when you produce 100 more units you find out that your marginal cost is equals to 100 equals to rupees 10 and your marginal revenue is also equals to 10. Now this gives you a hint, you should stop at this point because you have already achieved the point of profit maximization. So if I would have been able to find out that this is going to happen to me, I would have stopped at point C. Let's see, here I would have stopped, but nobody can do that. So the moment I reach this point, this gives me the idea or the hint that you should not go beyond this point. You should have stopped earlier, but since you could not stop because you cannot predict future, you should stop at this point wherein your marginal revenue is equals to marginal cost. Because if you go beyond this point, what will happen? Let's say I produce 200 additional unit. So what is my marginal cost here? See, marginal cost is increasing to 12 rupees, but what is the additional revenue I get is 10 rupees only. So it means 2 rupees in the negative zone. Alright, so I should not go beyond this point, beyond the point wherein MR equals to MC. So if I have reached this point, I should decrease my level of output, and if I am below the point wherein MR equals is more than MC, I should increase the level of output. So that's why MR is equals to MC is known as the point of equilibrium for the firm. MR equals to MC is known as point of equilibrium for the firms, not for the industry but the firm. So it means how many units I produce? 500 plus 500 plus 200 plus 100. Alright, so it will be 1000 plus 200 1300. So 1300 is the total output of this firm that will be added to the market output. Likewise, some firm will achieve MR equals to MC at 10,000 units. So that will again be added to this industry output. So point of equilibrium for the firm, or we can also call it as point of profit maximization. So whenever they use the word maximum or maximization or equilibrium, I've told you the trick. Just remember that their question is related to MR/MC. But when they talk about profit or loss, it means they're talking about AR and AC or ATC. Clear? Understood? So this is how you determine the equilibrium for the firm. But how do you determine in a perfect competition, the profit and loss for the firm? So to determine the profit and loss, you have to compare. To determine profit and loss, you have to compare average revenue with average cost will cost, AC or ATC. And we say that when AR is equals to AC or ATC, what we earn is the normal profit. When AR is more than AC or ATC, what we earn is the supernormal profit. And when AR is less than AC or ATC, we incur loss or also abnormal loss. Now, how to determine loss or abnormal loss? You have to find out the difference between AR and AC or ATC. If the AC is little more than AR, then that's a loss. If the AC is significantly more than AR, then it becomes an abnormal loss. So AC more than AR will give you losses if they ask you a generalized question. But if the AC is significantly more than AR, that will turn into abnormal loss. So how will I put it into a diagram? Let's see. On the y-axis, you would consider cost and revenue. Here is the output on the x-axis. This is in a perfect competition. This is your AR curve, which is also equals to MR curve, which is also equals to price. This is your AC or ATC curve. Why it is U-shaped? If students have You have problem, you go and see the revision classes for chapter 3, you will understand it. AC or ATC, and this is your marginal cost. Now you will find at this point not only AR is equals to AC or ATC, this is a perfect point, but also MR is equals to MC. But here we are talking about perfect profit and loss. So remember, many a time they try to trick you by in a question, and they will try to confuse you whether the question is related to MR, MC or AR, AC or ATC. So just don't fall into the trap. If they ask you simple about profit and loss, simply about profit and loss, ignore MR, MC option altogether. Close your eyes and ignore it. Alright, the question is related to AR and AC or ATC. But if they use the word maximum or profit maximization, or they use the word equilibrium, then you ignore the option AR or AC ATC. It means the question is related to MR and MC. Keep that in mind. Alright. So at this point, so we are concerned about profit and loss. So we are going to talk about AR and AC or ATC. So at this point you will find that AR is equals to AC or ATC. But you take any other point, if you take this point, you will find that here this is your AR and this is your AC or ATC. So AC or ATC is more than AR here, AR, or you can say AR is less than AC or ATC. So again there is a loss, and here at this point if you see, and why this loss is there, because of underproduction, you are not utilizing the full potential of your capital inputs. So that's why there is a loss. So if you produce more, you will achieve a situation of a profitability. And at this point also here you are overproducing, you are using your asset beyond the optimal output level. It means the TP is falling down, it means MP has become negative if you see from the production perspective. So here your again is your AC and AR. So here also you will find that AR is lower than AC or ATC, again loss. So you have this situation wherein there is a normal profit. Now you can say, sir, why can't there be, where is the point wherein there is a supernormal profit? You see, I have told you supernormal profit will never be achieved in the perfect competition. But if suppose hypothetically you have to, then you must be in a position to change this price. To change this price, if suppose if I am able to change this price and move this line upward, move this line upward. Now if suppose this is the price line, now you see what happened here. If I compare this, you'll find, if you compare this, you if I've increased the sorry, not increase this line, but here you change the price, demand will increase. So what will happen now? Now your AR is again lower than AC or ATC. It means what is happening is supernormal profit is further increasing. So you cannot decrease the price even though demand is increasing, but you are not able to cover up. But what if you increase this line here, increase this line here? Now you see here, when you increase this line, then what happens if this becomes your AR curve now. This is your AR curve. If I take this point, let's say take this point, AR is more than AC or ATC, isn't it? So you are earning supernormal profit, but that is not a possibility. That's why it will never happen. Hypothetically, you can draw this diagram. In your book also given hypothetically you can draw, but it is not a possibility in a perfect competition for any firm to earn supernormal profit. Now the next question is, the student has asked, sir, when AR is equals to AC or ATC, isn't it break even? How they can be normal profit here? All right. Then we have to go into the concept, that is chapter 3, implicit and explicit cost. There was a concept I've told you that when there is zero economic profit, it means there is normal accounting profit. All right. Let's take this into consideration. If suppose your total revenue, you think from total perspective or average perspective, doesn't matter. Total revenue, let's take average revenue, let's take it so that you don't get confused. Average revenue was rupees 1000. Your average explicit cost or accounting cost or explicit cost was rupees, let's say 800. So what you'll get is 200 as the accounting profit. This is your accounting profit. Those who have missed out this concept, please go back in chapter 3 and revise it. Now, this is your accounting profit. If I deduct implicit cost here, implicit cost is the cost of foregone opportunity, we also call it as opportunity cost, is rupees 200, which is also called as non-accounting cost. Non-accounting cost is 200. So what you get is zero economic profit. Profit is zero. But if you don't have this information, let's say, don't you think accounting profit is 200? Remember, there will always be an opportunity cost. For example, if you had 1 crore rupees and you are investing in the business and the business gives you a return of, let's say, 10 lakh rupees. Now this money could have been kept in the bank and the bank would have given you 6 lakh rupees annually. So how much additionally you are earning? Additionally you are earning only 4 lakh rupees, right or wrong? But if you ignore the bank interest part, your books of account will show a profit of how much? A profit of 10 lakh rupees. Clear? So that's why we say AR is equals to AC or ATC is a normal profit, because we are taking both implicit and explicit cost into consideration. If we do not take implicit cost, then you will find that AR becomes more than AC. Let's say AR is equals to rupees 100, alright, but and AC or ATC is equals to rupees 100 also. In this AC or ATC, there is explicit cost or accounting cost is rupees 80. Alright. Explicit cost is accounting cost is rupees 80 and implicit cost or non-accounting cost is rupees 20. So when I combine this, the total cost or total average cost ATC, average total cost is rupees 100. Right or wrong? But if I do not take this into consideration, let's say if I do not take this into consideration, then don't you think you have an accounting profit of rupees 20? So that's why when you are talking about accounting cost, you generally ignore the implicit cost. And the moment you ignore the implicit cost, it means you're not talking about economic profit, you're talking about accounting profit, and there will be accounting profit in that case. That's why we say when AR is equals to AC or ATC, since we are covering both explicit and implicit cost, explicit or implicit average cost, that's why we say it's a normal accounting profit, because we are considering economic profit, not only not accounting profit. Now I hope that's clear. Now we come to the concept of production continuation and discontinuation decision. All right, production continue or discontinue. Just hold on. Production continue or discontinue decision. When of any firm start business, from day one it may not earn profit. Now remember, when I'm talking about a business a firm starting business, it means I'm talking about short term. So this particular situation, production continue and discontinue decision, is a short term concept, because no firm can operate in the long run incurring losses. All right, in the short run every business or most of the business may incur losses, but the thing is, what is the extent of this loss, that will determine whether he should continue to produce or he should discontinue to produce. Now, when to determine the production continue and discontinue decision, what we'll have to take into consideration is the average revenue, that is nothing but the price with average variable cost, not average total cost, average variable cost. Clear? So there are three situations. First is AR or price is equals to AVC, then AR is more than AVC, and then AR is less than AVC. Alright. Now all these 3 points are loss making situation, but the extent of losses will be different in different cases. Alright. So let's take the first situation. Let's say average revenue or the price per unit is rupees 100. AR is equals to average variable cost. Price per unit is rupees 100 and average variable cost is rupees 100 also. But the total cost or average total cost consists of average fixed cost as well. Now if I take that into consideration, what will be the situation? Let's say average total cost, which is a summation of average variable cost plus average fixed cost. Alright. Let's say average variable cost is 100 and average fixed cost is rupees 50. So average total cost is rupees 150. So when you are producing and selling any commodity, you are earning per unit is rupees 100, but you are spending 150. So loss making, clear. But should you continue to produce or discontinue to produce? Now many firms will take a decision to discontinue to produce, which is wrong. That's why this is known as a shutdown point. This situation is known as a shutdown point. Shutdown point. But remember, the production must be continued. Production should continue. That is the ideal situation. Should continue. Why? What is the reason behind it? You find everything has a reason. Let's say I stop producing. Let's say hypothetically I should be producing. Sellers, they'll take a wrong decision of shutting down the output here because they think that they're incurring huge losses, which is wrong. Alright. So let's say it stops production. If he stops production, how much of price he is not earning? He is losing out rupees 100 average revenue, he is losing out, he will not earn this. How much of average variable cost he will not incur? It means this average variable cost of rupees 100 he will also not incur. When output is 0, total variable cost is 0, so average will also be 0. So it means I will earn 0 and I will spend 0 in terms of average variable cost. But average fixed costs do not go away, because when total output is even at 0, total fixed cost is never 0. So average fixed cost cannot be 0. So average fixed cost you still incur, right or wrong? So it means, what is the leftover burden on the firm? The leftover burden is rupees 50. Burden upon firm is rupees 50 if he has discontinued to discontinued to the production. Let's say he continues production. If he continues production, it means what comes in his pocket in terms of average revenue, that is price, that is rupees 100 he earns, and what is the average variable cost that he incurs, that is rupees 100. Alright. So what is the burden now? The burden remains the same, that is 50 rupees in terms of average fixed cost. Clear? Moreover, when you produce more, you can beat down your average fixed cost further, so you can decrease your losses. So that's why we say that you should produce, because whether you produce or discontinue to produce, the burden of fixed cost do not go away. The burden remains the same. And since your intention is to continue doing business, why not you should continue? Because the burden is not going away even if you shut down. You have to pay the rent of the building. You have to pay the minimum electricity fixed charges. You have to pay the property tax. You cannot say I'll not pay this, or you have to pay the bank interest on the loan that you have taken. You cannot say to the bank that, see, my production is zero, so I will not incur the interest cost. No, that is fixed. The bank will take away your business, take away your asset. So you cannot say that. So I will continue to produce. All right, because whether I continue or discontinue, my burden doesn't go away. But a good situation can arrive. See, two things can happen when I continue to produce, good and bad. What is the good thing can happen? The market price may increase. There could be some sellers who leave the market, and the entire market price for every seller may increase. Now let's say my average revenue or the price increases to rupees 120. Now what happened? You see, my average total cost remains the same. That is average total cost, that is consisting of average variable cost plus average fixed cost. It is rupees 100 here and rupees 50 here. I have continued to produce. So now what happens? The revenue covers all my average variable cost because I'm getting a plus of 120. It means I'm left with positive of 20. This positive of 20 will take care of some of my average fixed cost. It means I am left with negative of 30 only. It means my burden decreases from 50 rupees to 30 rupees. Isn't it a good thing? Yes, I'm still incurring losses, but don't you think my losses have come down? If I would have stopped in the first situation, then I would have never seen this particular day. So that's why when in the first case, whether I produce or don't produce, my burden remains same. It is better to produce because you may achieve this situation, you may come across this situation. And moreover, if further the market price increases and you reach a position wherein the market price is 150, that means you are entering from a loss making zone to a profit making zone. But so that's why in this case, when AR is more than AVC, then you should also definitely continue to produce. So in both the cases wherein AR is equals to AVC and AR more than AVC, you should continue to produce. Keep that in mind. But bad thing can also happen. If good thing can happen, then bad thing can also happen. What bad thing can happen? Competition may further increase, and due to which the price or average revenue may decrease, let's say from 100 rupees to 80 rupees. Now what happens? Again, when I say average total cost, that is a summation of average variable cost plus average fixed cost, and average total cost, average variable cost is remaining the same as 100, average fixed cost is 50. So average total cost is 150, but now this 80 rupees do not cover entirely my average variable cost. Let's say 80 here. It means I'm left with negative of 20 rupees. So what is my total burden? Total burden is this 20 rupees of average variable cost that I'm not able to recover. This 20 rupees plus the burden of 50 rupees. So now my total burden per unit becomes rupees 70. It's better to shut down. Why? Momentarily. Why it's better to shut down? Because if you shut down, then in that case you can decrease the burden from 70 rupees to 50 rupees. Let's say you shut down. It means this AR of 80 rupees will not come to you, but at the same time you will not incur an average variable cost of rupees 100. This will you will also not incur. All right, isn't it? So now what happens here? If you do not produce, then you do not incur this 100, you do not earn this 80 rupees. So it means this 100 rupees of burden is gone. What is left is 50 rupees of burden in terms of average fixed cost. So your burden decreases from 70 rupees to 50 rupees if you decide to discontinue the production. So that's why when AR is lower than AC, sorry, is lower than AVC, you should discontinue production or output. Clear? All right. I hope this is clear. So let's move on to another competition, that is monopoly. In fact, this is not a competition, but it's a market situation when there is only a single seller. Monopoly. See, the meaning of monopoly is alone to sell. Clear? It means alone to sell. It means there is a single seller or a single firm or a single firm. Now this is the reality, it can happen. Alright. So what are the characteristics when you find out in case of monopoly, and sometimes they also ask you what is the common feature between monopoly and a perfect competition, right? One common feature between monopoly and perfect competition is that there are homogeneous goods or goods are perfect substitutes. Why? Because if the seller is alone, it doesn't matter which market is selling, whether it's selling in Andhra or Karnataka or Tamil Nadu or West Bengal or Delhi. Every commodity comes out from the same factor input that is using, from the same technology is using, from the same mix between labor and capital is using. So the quality will not differ whether it's selling in one market or another market. Let's say there is only one phone company, Apple, which sells phone in the market. Let's say hypothetically, there is no other mobile phone manufacturer. So you buy an iPhone in India or you buy an iPhone in US or in Dubai. Do you think there will be different features, hardware difference and software difference between these countries? No, they will not be. Alright. Now the price can differ. Now you're saying that price can differ in a perfect competition. The price is also same. The price differs, reason being that there could be different taxes in different countries, and due to tax and other events, if the manufacturer is forced to increase the price, then we cannot say that there is a price discrimination which is going on. All right. So homogeneous goods or perfect substitute are sold because the same commodity is produced by the same seller in different parts of the world or different parts of the country. That's why we say which is common to a this feature is common between monopoly and perfect competition. But rest of it are just opposite. There were many sellers in perfect competition. There is a single seller in case of monopoly. There was the firms are price takers in perfect competition. Here the firm is a price maker because I am the king of the market. I will determine at what price I am going to sell my product. There is no prevailing price for this particular product in the market because it is not produced by anybody else. So I will determine at what price I am going to sell this commodity in the market. Alright. Due to this situation, you will find that because the seller is alone and is a price maker, there will be price discrimination. It means the same seller is going to sell the same commodity at two different prices or multiple different prices in different locations or different parts of the country or different parts of the world, despite the cost of production is same. If the cost of production changes to which I'm selling in different prices, that's not price discrimination. All right. So price discrimination, I am in a position to discriminate between the consumers because I know that if they want to buy this product, they have to come to me. There is no other seller. I cannot lose my customer. You can either buy or not buy. There is no other option or substitute available. So don't you think if suppose you go to a shopping complex and there is only one seller who's selling that particular commodity which is not sold by any other shop, don't you think he has a better negotiating power? But if the same commodity is sold by multiple sellers, then he will not want to lose the consumer, because if he loses, the consumer may not come back. But if he's a monopolist, he knows that I am the only one who's selling. If one customer goes away, another will come, or the same customer will come back, because he may search the entire mall and he will not find that particular commodity that I'm selling. So he will not be willing to bust from the price that he is quoting. So there will be price discrimination. But also remember that price discrimination depends upon factors. What are these factors? All right. Price discrimination depends upon, first thing, on what factor the price discrimination depends upon. There should be single seller, otherwise there will be no price discrimination. Single seller. That's why price discrimination is only a unique characteristic of monopoly. Second, it should not be possible for any seller to buy from a low price market and sell in a high price market. If suppose uh, a monopolist is selling in Delhi at rupees 1000 and in Mumbai at rupees 2000, I will buy 1000 from the monopolist. He cannot stop a consumer from buying. And and sell in Mumbai at 1500 rupees, wherein the monopolist is selling at 2000. I'm selling at 1500. Why? Because I purchased from a low price market. I can afford to sell at 1500 rupees. Despite that, I'm making a 500 rupees of profit. So it should not happen. If this is a possibility, then price discrimination is not possible. So, sir, should not be possible for others to buy in low price market and sell at a high in a high price market. And the most important factor it should which will lead to price discrimination is elasticity of demand. The elasticity of demand should be different in different market. If the elasticity is same, then price discrimination do not happen. Now, when the demand is elastic, E greater than 1, when the demand is elastic, a monopolist will charge a lower price. But when the demand is inelastic, E less than 1, he will charge a higher price. Remember that. When the demand is elastic, it means consumers are very sensitive. When the consumers are sensitive, you cannot exploit them more. You can exploit them a little bit, but not more. Because if I increase the price by 10%, the quantity demanded fall by 20%, it means it will lead to loss of my revenue. Alright, not losses, but loss in my revenue. My profitability will come down. But if the demand is inelastic, and in that case, if I increase the price by 10%, the demand may fall by 2%. So still, there is a gain of revenue by 8%. So that's why when the demand is inelastic, I'll charge a high price. When the demand is elastic, I'll charge a low price. So let's say there are two markets, alright, market A and market B, alright, market A and market B. If the demand in market A is elastic and market B is also elastic, it means in market A I have to sell at a lower price, in market B also I have to sell at a lower price. So in this case, when I'm talking about price discrimination, there is no price discrimination is happening, because in both the market I'm selling at a lower price. Moreover, if the demand is inelastic in market A, I will charge a higher price, and the demand is again inelastic, I will charge a higher price. Remember, if I'm exploiting the consumer, that doesn't necessarily mean that I am discriminating prices. If the demand is inelastic in every market, I'll exploit every consumer in the same way. The moment I exploit every consumer in the same way, it is not a price discrimination. But if I exploit some consumers more and exploit some consumers less, then there is a price discrimination. Doesn't matter what is the price. Alright. So in both markets, so high price, so again there is no price discrimination. But if suppose in market A the demand is elastic, alright, E greater than 1, so it means I'll charge a low price here, and in market B demand is inelastic, I'll charge a high price here. Here the price discrimination is taking place. Or if in market A the demand is inelastic, I will charge a high price here, and the demand is elastic here, I will charge a low price. Again there is a price discrimination. So price discrimination is only possible when there are different elasticities in different market. If the elasticity is same, then price discrimination can never happen. Alright, so keep that in mind. In fact, Pigou gave 3 different types or degrees of price discrimination. AC Pigou, very frequently they ask this question. 3 different degrees of price discrimination. First, he says that a monopolist will be very powerful and he will exploit the consumers to the hilt. It means whatever the consumers are willing to pay, consumers are willing to pay a high price because they know there is one seller who is selling the product. He is not going to give me a discount. So I'm willing to pay 100 rupees. The seller will charge 100 rupees. So there is no consumer surplus. Alright. So there is no consumer surplus. Monopolies will charge the highest possible price. He will be very powerful. Alright. This is known as first degree of price discrimination. Second, the seller will try to increase its sales by decreasing the price. If the sellers know that the demand is elastic, then he will give a little bit of discount, and if he decreases the price by 2%, the sales increases by 5%. So it means 3 rupees, 3% of additional revenue he will generate. So he will be willing to compromise when it comes to price by decreasing it, because his returns will be higher. So consumers are willing to pay 100 rupees, he will charge 98 rupees, right? So there will be some consumer surplus. So in this is known as second degree of price discrimination. Because remember, when we are asked that even in a monopoly the law of demand will not be violated. Why? Because if you're selling even as a necessary commodity at a very high price, I cannot afford, a poor man will die. Alright, generally you have two options when it's not a monopoly market. One, not to buy the product. Second, to replace sellers A product with sellers B product. But in case of monopoly, you have only one choice, whether to buy or not to buy. You cannot replace with another substitute because no substitute is available. Alright, so that's why we say that cross elasticity in a monopoly is zero, but elasticity is inelastic. Demand is inelastic because consumers have only one choice, not two choices. So this is second degree of price discrimination. So that's why we say that monopolies can either decide price or output. If he increases the price, some consumers may not be able to pay. They are willing to pay, but it's beyond their budget line. So they will be out of out of the consumer, you can say out of the list of consumers who are going to buy from that monopolist. So the demand will come down. So if you try to keep the price high, demand will automatically come down by a small amount, but it will come down. But if you want to increase the demand, you have to lower the price so that those who are not previously able to afford it down, they can afford it. So I can, if I'm a monopolist, I can either decide price or output. I keep a higher price and higher output, not possible. I want to increase the price, increase the output, not possible. If I want to increase the output, I'll be forced to decrease the price. It means I'm deciding about the output. In that case, I'll be forced to decrease the price. And if I want to keep the price high, then automatically the output will decrease. So I can either decide price or output and not both. And third degree of price discrimination is when the monopolist divides the market based upon consumers' taste, preferences, their income, demography, cultural settings, everything they will take into consideration. Alright, if he's selling burger in a place wherein more 80% of the people living are youngsters, they will charge a high price. If he's selling a burger in a place wherein middle income earning or middle aged people are there, he will charge a little lower price. If he's selling the same burger in a place, if suppose burger has a monopoly market, and if he's selling the burger in a place wherein 80% of people are the old fellows, he will have to charge a very low price. Alright, so he will divide the market according to various situations. So that will be your third degree of price discrimination. Clear? Keep that in mind. Now next comes, now price discrimination is done, perfect substitutes will be sold. There will be advertisement cost incurred or not. Yes, in the short run he may incur some advertisement cost to tell the consumer that I am the one who's selling the product, but never in the long run. Why? Because I've told you the purpose of advertisement is to tell the consumer that my product is better than your product, my competitor's product. So in the long run, when the consumers know that he is the one who's selling it, because in the short run I have done some advertisement, so in the long run I don't need to keep telling them that buy from me, buy from me. I've Because the consumers not now know that I'm the one who's selling it. Clear? So there will be no advertisement cost in the long run. No advertisement cost in the long run. Then we say whether the monopolies will earn normal profit, abnormal profit or losses. See, losses can happen in every business in every market. So forget about that. You see, Indian Railways is run by government is incurring losses, right? But abnormal profit may not always happen. Normally we say in case of a monopoly, there will be abnormal profit, but there can be losses as well. So it is possible for firm, or you can say for a monopolist, to earn even abnormal profit or supernormal profit in the long run. Losses can happen everywhere. All right, is it clear? I hope this is clear to you people. Then comes, if I am a monopoly, am I a price taker or price maker? I have told you. But when it comes to entry or exit from the firm, if I'm a monopolist, I will try to protect the market. I'm the leader in the market. I'm not the leader, I'm the only person selling the commodity. So if a new seller is going to enter the market, he will take away some of my consumers only, no? So what I'll do, I'll create a price barrier. How will I create a price barrier? Suppose my cost of production was 100 rupees, I was selling at 500 rupees, exploiting the consumers to the hilt. A new seller is entering the market. I will start selling at 90 rupees. Will I be able to afford it? Yes, I'll be able to afford it because I've been exploiting the consumers since so long. I can afford to sell at a loss for a momentary period of time, for a small period of time. Now, a new seller entering the market cannot afford to start businesses by selling at a loss. And he may sustain it in the short run, but never in the long run. So what will happen? The moment a new seller is trying to enter the market, I will decrease the price to the bare minimum. Consumers will buy my product, they will not be able to buy competitors' product. Even if they are able to buy competitors' product, the competitors have to sell at a lower price, at a loss. So they will not be able to sustain, they'll be kicked out of the market, incurring losses, they will never go in the long run. When they are out, I will increase my price. Now I'll increase my price. I was initially selling at 500 rupees, which I reduced to 90 rupees. Now I'll be trying to recover all my losses, and now I'll sell at rupees 700. What the consumers will do? All right, what the consumers will do? That's why we say, in you see FDI in retail, government is very susceptible to allow retail 100% FDI in retail. Why? Because Amazon, Walmart, these are giant. If they come to India and they start selling it, you'll be very happy in the beginning. Buy one get one free, buy one to get two free, something like that. There'll be Black Friday, Black Sundays, whatever you call it. You'll be very happy. Oh my god, my living standard have increased and this and that. But what will happen? People will stop buying from small kirana stores. Slowly, when these stores will shut down, slowly when Indian companies who are also in retail businesses, they shut down. Now the ground is clear for Amazon or for Walmart to exploit the consumers. They will increase the price, and they will increase the price so much so as to cover the past losses as well. What the consumers will do? Now the kirana store is gone. You have no other option to buy from Amazon or to buy from Walmart, or not to buy. Can you survive without buying vegetables, without buying rice, pulses and everything? Or do you think you can buy straight from the farmer going to villages? It's not possible for you. So what you'll do, you'll have to pay whatever high price they demand. That's why these big firms, they have a tendency to create monopoly or monopoly like situation to whichever market has they have gone. That's why Amazon and Walmart are facing antitrust and anti-competitive petitions in many of the European countries. In many of the European countries, Walmart has been kicked out because they have destroyed the local sellers. So that's why we cannot allow private monopolies to come up. That's why for that reason we have Competition Commission of India, and you know the fight is going on between Reliance and Amazon on the over the sale of future retail. They are fighting in Singapore, they are fighting in India, in India, and who knows where the fight will go and who will win. But it's better for an Indian firm to win compared to a US firm, because we cannot allow outflow of capital from India to out. Yes, we can allow foreign competition to happen in India, but not at the cost of Indian small businessmen. All right, clear? So possible, uh, so there will be a very strong barrier to entry, very strong barrier to entry, strong barrier to entry. Now when it comes to uh, the demand curve of a monopoly, you will find that AR and MR curve, they will be different. This is your AR curve, this is the MR curve, just hold on, AR curve, this is the MR curve, this is marginal cost, this is the point of equilibrium wherein MR is equals to MC. Now remember, the concept of MR equals to MC as an equilibrium will not change whether it's a perfect competition or monopoly or monopolistic. Why? Do you change the golden rule of accountancy when you're changing your accounting from partnership firm to a company firm or from a partnership to an LLP? No, it's not going to change. The golden rule remains the same. The debit and credit ideas remain the same. Alright. So that's why the concept of equilibrium for every firm in every type of competition remains the same, that is MR equals to MC. If you are selling beyond this point, what will happen? If suppose this is equals to MR equals to MC and you are trying to sell at, you are selling at this point, you are selling now, if you want to increase the level, what will happen? You see your marginal cost is here, but the marginal revenue is here. So negative zone, you should not be doing it. So you should produce at the point wherein MR is always equals to MC. You should, if you have gone above MR equals to MC, you should decrease the point, decrease the level of output. It means when MR more than when MC more than MR, the output should be reduced. When MR more than MC, when MR more than MC, the output of production should be increased, and you should try to achieve the point of equilibrium wherein MR is equals to MC. Alright, clear. Now why it is a downward sloping curve? Remember, the demand curve between monopoly, this AR curve is also the demand curve. Why AR curve is the demand curve? Because demand equals to price. When we studied about demand, what did I tell you? That willingness to buy and ability to pay for it. Now willingness to buy depends upon your marginal utility. That's why MU curve is also known as the demand curve. Ability to pay depends on the price. If the price is more, demand will come down. If the price is less, demand will go up. So that's why AR curve is also known as the demand curve. Now the demand curve is downward sloping. Why? Because there is a price discrimination and the monopolist is charging different prices in different market from different consumers. Clear? That's why it's downward sloping, but it will be less elastic or inelastic because consumers don't have the option of replacing one commodity with another seller's commodity because there are no substitute available. They have an option to buy or not to buy, but not to replace. That's why demand curve is inelastic. You'll find very similar diagram for monopolistic, but the demand curve will be more slanting. All right. Why? Because the people have two options now, whether to buy or not to buy, or whether to buy more from you or less from you. It means you can substitute. Let's come to the concept of monopolistic market. Monopolistic competition. Here you'll find, now one thing I've missed out in perfect competition is that we say that there are large number of small sellers. In case of monopolistic also there are large large number of large number of small sellers. The word small is of relevance here. Why large number? We say small seller. See, the small or big firm is not determined according to the capital invested by that firm. That firm would have invested billions of dollars or rupees, but still will be considered a small firm. Why? Because any particular firm do not have so much of market share in terms of sale of their product that they can bring about revolutionary change in the market. You see, companies like ITC, they are considered to be very big firms, all right, but what is the market share in terms of soaps and shampoos? They have 2%, 3%. So a company which is controlling 2 or 3% of the stake in the market, it means 2 or 3% of the consumers are buying their product in the country, do you think it can bring about a revolutionary change? Now in a country as big as India, 2% can mean a huge number of amount of profit, but still it's a small share in terms of percentage. When you're talking about in absolute sense, it will be very big, but in percentage terms, only 2% of the consumers or 3% of the consumers are buying their product. They cannot bring about a revolutionary change in the market. That's why when Baba Ramdev came, Patanjali came, everybody was going to say, was saying that there will be a revolutionary change in how consumers buy their product in India. I knew that it's a lie. Why? Because it doesn't matter how big you become in terms of your profitability, in terms of your capital invested, you will never end up controlling 40-50% of the market share. That way you can become a big or dominant seller. But what is the market share of Patanjali today? 4-5%. Can I say it became, I mean, has there a revolutionary change in terms of soaps and shampoos that we purchase on a daily basis, or the wheat, rice or pulses that we purchase on a daily basis? Do you tell me? There has been a revolutionary change in telecom, but there has not been revolutionary change in FMCG products. Alright, the revolutionary change would have been if suppose the market share of one company of Patanjali would have jumped from 5% or 4% or 3% to 70 or 80%. That has not happened. But the same company like ITC, in terms of cigarette manufacturing, it is considered as a big firm. Why? Because it controls more than 60 or 70% of the market share in terms of cigarettes or different brands of cigarettes it sells. So large number of small firms are small because they cannot affect the market price significantly through their output decision. That's why we say large number of but small sellers. Same goes with perfect competition as well. Now the firms here, they sell similar but non-identical goods. It means goods are substitute but not perfect substitute. Goods are substitutes but not perfect substitute. You buy Bingo or you buy Lay's chips, it will be very similar but not identical. They are substitute but not perfect substitute. So goods will be similar but non-identical. You buy an LG television or a Philips television or a Sony television or a Samsung television, they will be very similar to one another. The price will also be, you know, very close to one another if you are buying the same segment. All right, but they will not be a perfect substitute. So goods which are sold are similar but non-identical. It means they are substitute but not perfect substitute. Then will there be price discrimination? You use your common sense and tell me. Do you think when you go and buy a Sony television from one seller and I buy the same model of television from another seller, do you think the price will vary for us? Yes, the price may vary, but the discount is given by the retailer, not by the company. The distributor price is the same for everybody. It means if I have a showroom and if I'm purchasing from Sony, the Sony will charge me the same price how much it will charge from to other retailer. It will not charge different prices from us. From my end as a retailer, I can give a discount to you. The company is not discriminating. The sellers may the retailers may discriminate. So that is not price discrimination, because the original producer must be willing to discriminate the prices. So when you buy an iPhone from Amazon and I buy an iPhone, do you think the same model, do you think the price will be different? Yes, between Amazon and Flipkart, they'll give you some little bit of here and there discount, but that discount is given by Amazon or Flipkart. It's not given by Apple. From Apple, they're buying the product, the iPhone at the same price, whether it's Flipkart or it's Amazon. All right. So there will be no price discrimination. And remember, rationally also, when there are more than one sellers, there can never be price discrimination, because the consumer will move very easily from one to another seller. All right, so no price discrimination. Despite the fact that the firms are price maker, there will be no price discrimination. Now they are price maker because it's a competitive market and there is not a single price prevailing in the market. Because if suppose you are selling soap, you come across, you say this is a good business idea, I will sell soaps in the city of Bangalore. Now which price you will take as a benchmark? Because there are more than 100 or 200 companies who are selling soap. Some are selling soap per bar at rupees 500, some are selling at rupees 50. All right, if you see, and some are selling at rupees 10, maybe some may be selling at rupees 5. So which price you will take? To take up the price, there should be single price prevailing in the market. There is no single price. So I will determine what is the quality of my product, how I try to move the consumer preference, and I will determine between this 500 and 5 rupees range at what price I'll sell. I may sell at 250, I may decide to sell at 200, I may decide to sell at 100 rupees, I may decide to sell at 150 rupees, I may decide to sell at 600 rupees, or I may decide to sell at 3 rupees. At what price in this range I will sell, or beyond the range I'll sell, that determines on me. That depends upon me. So I am a price maker, not a price taker. Depending on the competition, I will decide what is the price. That's for sure. But at what price I'll sell, that will be my decision. That's why we say we are the firms in a monopolistic market is a price maker, not a price taker. There will not be barrier to entry. Why? Because so many firms are selling the same commodity, it's very difficult for them to come to collusion to stop any new seller entering the market. Now, moreover, if I'm owning only 2 or 3% of the market share or 5% of the market share, I will not be bothered when new sellers are entering the market, because the new seller is not necessarily take away my consumers. There are 95% of the market share is owned by 200 different sellers in the market. So I will just focus on my product. I will try to advertise my product and tell them that my product is better than all other sellers' product. But I will never be in a position to create a price barrier for any new firms to enter the market. A new firm will quickly enter the market. If they are able to sustain their business at profit, they will sustain. If they are not in earning profit, they are incurring losses in a very short period of time, they will shut down their businesses. So no barrier to entry or exit. Entry or exit. Clear? Now, do you think the firms will make profit, normal profit, abnormal profit? You see, in the long run, because there are so many firms present, the firm will make only only normal profit in the long run. In the long run, losses can happen every time. Forget about that. In short period or long period, every loss is possible in every business at every point in time, whether short run or long run. So we are not going on to that. So profit in the long run, only normal profit they will make. But in the short run, they can be for a very small period of time, they can be abnormal profit. How? Let me give you an example. When any new product is launched by any company and there is a unique feature in that product which no other sellers are providing, don't you think I will try to sell it at a higher price? Because I know that they will love this new feature and they will be willing to pay something higher for this particular feature. Example, when iPhone came up with a thumbprint recognition, before that what used to people used to make erratic patterns, and sometimes I've seen people making so many patterns they themselves will forget what are the patterns that made, and you have to every time you have to enter the passcode. Apple said, don't worry, 100% security, your thumb is not going, nobody is going to take away. You press the thumb on your fingerprint uh, this is a biometric fingerprint recognizer, and it will open up, unlock the phone. No other company was selling it. But Apple also knew that in the long run, every company will reverse engineer and it will start to give the same feature. And it happened in a matter of 6-7 months. Samsung and other companies started to give fingerprint recognition. Then it came facial recognition. Now every company, big company, give facial recognition. So in the short term time period, Apple knew that this is a unique feature nobody else is giving. So why not charge more? So they will charge more and they will end up earning abnormal profit. But in the long run, when all the others are giving the same feature, don't you think Apple will be forced to decrease the price? It will be forced. So whenever a new product is launched, all right, they can, if due to uniqueness of the product, the price will be higher, the company will make abnormal profit. But when everybody is selling this very similar commodity with some very similar feature, then the original company will be forced to decrease the price. So in the short run, they can earn a normal profit, but in the long run, they will only earn normal profit. Understood? Will there be advertisement cost? Remember, we say that monopolistic competition is a non-price competition. Now, what is the this term non-price is very confusing. See, it simply means that companies do not compete on price. Competition, non-price competition. Why? Because companies will try to fool the consumers through advertisement. They incur a whole lot of advertisement to tell the consumer that my product is best or better than other product. So they will try to sway the consumers towards their product through a lot of advertisement expenditure that they incur. Sometimes they'll put in David Beckham, sometimes Virat Kohli, sometimes some big celebrity like Amitabh Bachchan, and the fans will buy their product. All right, clear? The fans will buy their product. So it's a non-price competition. It doesn't mean that companies do not compete. It simply means company do not compete on price. Company can prefer to keep a high price and still people will buy more. Why? Because they will try to fool you through advertisement. So a lot of advertisement cost, hell lot of advertisement cost is incurred by the firm. There was a time when it was found out that the total direct and indirect cost of Nike, if you consider 60% of it cost was not manufacturing. If suppose it's incurring $100 to manufacture uh, if it's selling uh, a shoe at $100 and the manufacturing cost is $80, it means in that $80 you'll find that 50 to 60%, it means $40, $45 will be advertisement cost. All right, which is not a part of the prime cost. So that is the case because consumers can be fooled into believing that this is the best product and they'll be willing to spend more money. And you see, it goes against the law of demand. Which company sells the phone at the highest price? Apple. So according to law of demand, people, least number of people should be buying that phone. But is it the case? No. So sometimes people judge the brand and they ignore the price. All right, and even if Apple gives 10% or 20% discount, sale will increase despite the fact that even after giving 20% discount you'll be selling the mobile phone at 70,000 rupees or 80,000 rupees, and you have in 50,000 and 45,000 very similar phone available, but still people will run towards Apple, violating the law of demand. So they know that it is going to happen. That's why they spend a lot of money on advertisement cost. That's why we call it as a non-price competition. Clear? All right. Now when it comes to demand curve, the demand curve in a monopolistic market will be again very similar looking like just like the demand curve in a monopolistic market, but the only difference is if suppose here is revenue and cost and here is the output, it will be more slanting. AR curve will be more slanting because it is the demand curve will be more elastic. Why? Because now consumers have not only the choice to buy or not to buy, but also to replace one commodity sold by one seller uh, and through another commodity sold by another seller. It means I can stop buying Apple. I decide not to buy mobile phone altogether, or I may decide to stop buying Apple and start buying Samsung. So I have both the options available. That's why because of so many small sellers in the market, people have got more choices. You see, in case of demand chapter, I've told you if large number of substitutes are available to consumers, their choice making power will be very, very great. They can quickly move from one seller to another seller because so many options are available. So the demand will be more elastic, and this is your marginal cost. So again the equilibrium, as I've told you, in every competition will be same, wherein MR equals to MC, because if you try to sell at this point, you see here this is your MC and here this is your MR, MC more than MR, you are in the negative zone again. So equilibrium for every firm will come to the point wherein MR is equals to MC. Alright, that's all you need to know about the monopolistic market. Clear? So demand curve more elastic and equilibrium will be at the point wherein MR is equals to MC. One more thing, uh, excess capacity is found in which type of market, they have been frequently asking. Remember, it largely happens in case of monopolistic market because the firms have keep an excess capacity so that very frequently the sellers will enter the market and leave the market. So there will be a potential benefit for the firm to keep an excess capacity so that when the supply suddenly comes down, they can jack up the supply, increase the supply and make more profit. That's why excess capacity exists in monopolistic market. Now oligopoly. Now in case of oligopoly, there are different types of oligopoly, we'll see later, but we say that there are 2 to 10 sellers are there in the market. How this number is decided? Nobody decided number. We see in the market that when there is more like an oligopoly situation wherein 10 sellers, 12 sellers, 13 sellers, we see that more like it's 10. So that's why we set up a number. It could be 11 as well, but we kept it as 10. So when there are only two sellers present, we call it as duopoly, which is a part of oligopoly. Duopoly is a part of oligopoly. If I have to, uh, you know, if this is oligopoly, this is duopoly. It's a part of oligopoly. Only thing is there are only two sellers. That's it. Up to 10 sellers, it's an oligopoly. Now, oligopoly can be of two types when it comes to the nature of product they sell. It could be either pure oligopoly or it could be differentiated oligopoly. Also remember, in oligopoly is a market, it's a market wherein few dominant sellers have significant control over the market. In monopoly, there is one seller having significant control over the market. In in oligopoly, there are few sellers who are having, there can be 100 sellers as well, but few sellers, suppose less than 10 sellers or up to 10 sellers, they control 99% of the market, 98% of the market. All right. So having dominant control over the market. So we'll ignore those 1% of the sellers. We'll just look at those 10, 10 or 8 or 9 sellers. So in a pure oligopoly, you will find that homogeneous goods are sold. It means perfect substitutes are sold, which do not exist. Duopoly in nature do not, in the practical world do not exist. But differentiated oligopoly exists, just like in a monopolistic market, you had similar but non-identical goods. In case of differentiated oligopoly, you'll also have similar but non-identical goods. You see, mobile phone services in India is a oligopoly, right? Because 4-5 sellers, not even 4-5 sellers, if I consider Jio, Vodafone and Vodafone Idea now is the same, and Airtel, they control more than 80% of the market. So can I call it a monopolistic market? No, it's an oligopoly market. All right. But do they sell similar product? Yes, very similar product. Do they sell identical product? No, feature is here and there a little bit different. Price is here and there a little bit different. So I cannot call it as a perfect substitute. I will call it as a similar but not identical goods. Close substitute, I can say at best, but not perfect substitute. Then in a oligopoly, will there be price discrimination? You think and tell me. Do you think you buy Coke at 12 rupees, I'll buy Coke at 15 rupees? Do you think it happens? No, it doesn't happen. Alright. See, Coke can be sold at 12 rupees, Pepsi can be sold at 15 rupees. That is not price discrimination, because these are two companies involved who are selling similar commodity at at different prices. So if Coke is selling at 12 rupees, Pepsi is selling at 15 rupees. Pepsi is selling at 15 rupees to everybody, Coke is selling at 12 rupees to everybody. Discrimination is when the same seller is selling the same commodity at different prices to different consumers. When different sellers are selling same commodity at different prices to everyone, that is not price discrimination. I'll repeat, same seller selling same commodity at different prices to all the consumers, that is to different prices to different consumers. So that will be price discrimination. Same seller, same commodity, different prices to different consumers, price discrimination. Different sellers, same commodity at different prices, all right, but they are selling at that different prices to all the consumers, then it's not price discrimination. I've told you, Pepsi at 15 rupees to everybody, Coke at 10 rupees to everybody, that is not price discrimination. When Pepsi 15 rupees to some and 18 rupees to some, price discrimination, right? So in case of oligopoly, there is no price discrimination, and fundamental reason for that is that there are substitutes available. The moment there are more than one seller, price discrimination is never possible. So no price discrimination. All right, you will not buy Coke when you know that your friends are getting at 10 rupees and you are getting at 15 rupees. Next, in case of oligopoly, will there be normal profit or abnormal profit? See, in the short run, they can, again, just like a monopolistic market, can be abnormal profit. Alright. In the long run, if there is a collusion, there can be abnormal profit. But generally, if they ask you oligopoly, normal profit, abnormal profit, in the long run, there will be only normal profit. Losses can happen to everybody at every point in time. So, which is very similar to monopolistic market. Now, if they ask you the feature which is common between monopolistic and oligopoly market, One feature which is common is that both are non-price competition. Non-price competition. In fact, there is a cutthroat competition because there are few companies present only, and they try to beat one another through their through advertisements. Pepsi says that something is different, Coke says something is different. So Pepsi, say for example, Dew belongs to Pepsi and says cheetah bhi peeta hai aur dar ke aage jeete and all this and nonsense, and Coke comes up with another nonsense, says it takes care of thirst, rest all bakwas. Water takes care of thirst, not cold drink. Alright, so both are doing bakwas, but they will divide the consumer to go either with them or that. Right, so it's also a non-price competition because a hell lot of money they spend on consumer to sway consumer preferences from one to another product. Will there be barrier to entry? Yes, there will be very strong barrier to entry, because when few dominant sellers are there, they can come together to stop the entry of a new seller, and when the new seller goes away, they start competing again themselves between themselves. All right, so if you want to sell cold drink in India, or say for example you want to start a telecom business in India, you'll find that Jet, Airtel, Jio and Vodafone, all three will reduce the price to kick you out of the market. There could be collusion between them. All right, had there been hundreds of sellers, it will become difficult for all of them to come to common ground. But if there are 4, 5, 6, 7, 8, 9, 10 sellers, it's very easy for them to come to a common ground. So there will be a very strong barrier to entry, just as in case of monopoly, they will try to stop any new seller from entering the market and destroy their market share. All right. Then advertisement cost, I've told you, selling advertisement cost will be huge, right? Uh, in case of demand curve for an oligopoly, very unique demand curve you get, a very unique demand curve which is known as Kinked demand curve, which happens due to price rigidity. We also call it as indeterminate demand curve, right? Now remember, if they ask you price war happen in which type of competition, it will be oligopoly only. Why? Because in a monopolistic competition, they cannot be price war, because if I am controlling 2% stake and a new seller enters the market, and if it gives a discount, I will give a damn. Because you are controlling only 2%, if you're giving discount, do you think all my consumers will go to you? No, it's not going to happen. Alright, clear. But if there are only 4, 5, 10 sellers and one seller starts giving discount, then other will be forced. For example, pizza. The moment you will find that Domino's says 50% discount, 60%, 70%, buy one get one free, Pizza Hut will have to give the same discount. Why? Because they together share more than 80 or 90% of the pizza industry in India. So they can be a price war. Airline industry, they can be a price war. So what happens if suppose any seller increases the price of its product? If suppose you are my competitor, you increase the price of your product, I'll be happy. I will not increase the price in the same way. If you increase by the price by 20 rupees, I may increase the price by 2 rupees, or I may not increase the price. Why? Because we both are selling very similar commodity. If you increase the price, there are very fair chances that some of your consumers will come to me and my sales will increase. Clear? So I will be not willing, I'll be rigid to increase the price, rigid to increase the price. But what if you decrease the price? If suppose you decrease the price, you are selling at 10 rupees, you start selling at 8 rupees. Now what will happen? In some time, my consumers will start flowing to you. Will I like that? Losing my consumers market share? I will not like that. So what I'll do, I will also decrease the price, maybe by the same margin or by little more margin. So that will make the demand curve kinked or indeterminate. Let's take an example here. If suppose this is the price, this is the quantity. So if I have to draw the demand curve here, it will look like an unusual demand curve, right? Just hold on. What is happening? Just hold on. Now this is the king here, the key part. Above the king, it is said that a demand is elastic, E greater than 1, or the demand is elastic, and below the king, the demand is inelastic. Now, why do we say that? Let's say the price was here at the king, let's say P0, Q0. Now, if I increase the price, as one of the competitors in oligopoly, if I increase the price and other sellers do not follow the price increase in the same manner, it means they will increase the price but by a lower margin. If I increase by let's say 10 rupees, they will increase by 2 rupees, or they may not increase. So what will happen, that since I'm increasing the price, the law of demand will come into play. People will buy less from me and more from my competitors because there is a price difference. So since we are selling very close substitute, the elasticity of demand will be very high, and more number of people will go and buy that particular product from other sellers who have not yet increased the price, or who have increased the price but by a smaller margin. So their sales will increase by a bigger margin. So when I increase the price from P0 to P1, I'm increasing the price. The quantity demanded for my product will shrink from Q0 to Q1. Alright, Q0, it means there is a big change in quantity demanded relative to the price. But let's say when I decrease the price from P0 to P2, now when I decrease the price, what will happen? Your consumers will start coming to me. Will you like that? No, you will not like that. So what will happen? You will also decrease the price. So price difference is mitigated now. So I will only get some of your customers till the time when I have decreased the price and you haven't. But the moment you also decrease the price, like me, so the customers flow from you to me will stop. So I will gain from Q0 to Q2. You see, the fall in price compared to increase in quantity demanded is less. So when I increase the price, I will lose more of my customers because people are elastic. Because there is a price difference. When I am increasing the price, you are not increasing the price, due to which there is a price difference. But when I decrease the price, you also decrease the price. So I will gain, but by a small margin, only till the time when I have decreased and you haven't decreased. But you will be forced to decrease. The moment you decrease, the customer flow from you to me will stop. So I will gain by a small margin in terms of quantity demanded. In fact, from the seller's perspective, my supply will increase by a small margin. So from Q0 to Q2, this will make the demand curve kinked or indeterminate. Now why elasticity is more, I've told you, because there is a price difference. When E is less than 1, why inelastic? Because there is less price difference. More price difference, more elasticity, because I am increasing and others are not. Less price difference, less elastic. It means consumers will not be willing to much give up, willing much to give up, because when I decrease, you also decrease. So that's why inelastic. Clear? So this is known as price rigidity. It means when I increase the price, you will not increase the price, you are rigid. But when I decrease the price, you will be forced. In a usual demand curve, you will find that it is not kinked because the price and quantity demanded moves depending on the elasticity of demand. And elasticity of demand will not change much. Why? Because reason is that there are so many sellers in the market. Somewhere some seller will enter, some sellers will leave, so elasticity will not be much affected. But in an oligopoly, that is not the case. This concept was given by Paul Sweezy. Sometimes they ask you the name as well. Alright, so kinked demand curve is very important. Next, and this is a unique feature of oligopoly only. Types of oligopoly. This is one competition where there are several types. Types of oligopoly. Now pure and differentiated oligopoly, I've already told you at the beginning, that when goods are sold which are perfect substitute, it's a pure oligopoly. When goods sold are similar substitutes which are not perfect substitute but similar goods, it is differentiated oligopoly. Then comes next is partial oligopoly. Why do we call it partial oligopoly? Because it is neither a monopolistic business or market nor completely an oligopoly. In this case, you will find there are more than 10 sellers. There could be 50 sellers. Alright. So certainly we cannot call it an oligopoly. Then why don't we call it monopolistic? Because in a monopolistic market, there are large number of small sellers. No seller is big in terms of market, in terms of market, you can say structure, or what is their market uh, percentage in terms of consumers buying their product. So in case of partial oligopoly, there are 50 sellers, still we don't call it monopolistic. Why? Because there will be few dominant sellers and all other sellers will be small. For example, cold drink industry in India is an oligopoly, but it's not only an oligopoly, it will be wrong to call it an oligopoly, it is a partial oligopoly. Why it is a partial oligopoly? But because there are more than 10 firms which are selling cold drink, but 90% or more than 90% of the market is occupied by Coca-Cola and Pepsi. Coca-Cola and Pepsi. So there is a leadership situation. In a partial oligopoly, there is a price leadership. It means there will be one or two sellers which will be leader in the market and all other sellers will have to follow the leader in terms of pricing. If suppose I want to enter into the cold drink industry, I cannot afford to sell the cold drink at par with Coke and Pepsi. If they are pricing one bottle at 15 rupees, I cannot afford to sell at 15 rupees because people will not largely buy my products. Some people will buy, but mostly will not buy because I don't have a brand equity. I don't have a brand recognition which Coke and Pepsi has. So it means in order to get more customers, I'll have to sell at lower than 15 rupees. And I can only increase the price when the leader increases the price. I can sell at 15 rupees provided Coke and Pepsi starts to increase the price from 15 rupees to say 20 rupees, 25 rupees. So mostly they ask you a question like in which type of oligopoly there is a price leadership situation, and it will be partial oligopoly. Then comes open oligopoly and closed oligopoly. They are exactly opposite of one another. In an open oligopoly, there is no barrier to entry, whereas in a closed oligopoly, there is a barrier to entry. Sellers will come together to stop the entry of new firms. Alright. But also remember, related to this open and closed oligopoly, there will be a competitive oligopoly and a collusive oligopoly. Alright. Competitive oligopoly and collusive oligopoly. Now, a competitive oligopoly is one when there is sellers are competing against one another. So when sellers are competing against one another, they will not be able to come to common understanding to keep out a new seller. So automatically it will become an open, and very soon it will end up becoming also a monopolistic market. In a closed oligopoly, you will find that it is always a collusive oligopoly. Why? Because how can you create a barrier if you are fighting amongst one another? So you can only create a barrier when you are basically coming together to form a collusion, to come to a common understanding. You scratch my back, I'll scratch yours, we protect each other's interest. So in that case, what it will become collusive. A collusive oligopoly will always be closed oligopoly. This is what used to happen. What used to happen in case of telecom industry in India. It still happens in telecom industry in US. You will find AT&T and Verizon. They contain. I mean, these two companies have more than 95% of the market share in broadband and telephone. Because they have divided the market, said you remain in north, I will not poach on your customers, I'll remain in south. US is a big country. So when a new seller tries to enter my territory, I will deal with him, and when a new sellers want to your territory, you deal with it. And if we increase the price, will increase together. If we decrease the price, will decrease together to keep the new sellers out. So that is a collusive oligopoly. Collusion means coming to common understanding to protect each other's interest in the market. All right. Then there comes what is known as a syndicate oligopoly. Syndicate oligopoly. Many of you, the students, they were asking about the syndicate, oligo, and organized. They seem to be very similar. Yes, they are very similar, but not exactly similar. Oligopoly. In a syndicate, syndicate means an association. When you form an association, so what will happen in this case, there are up to 10 sellers who will form an association. It could be less than 10 also. So let's say there are 5 or 6 sellers, A, B, C, D and E. They will come together. This is kind of a collusion. This will remain a closed oligopoly due to collusion. Under collusive oligopoly only comes organized and syndicate. So if you have a collusive oligopoly, it has two branches. One is syndicate, one is organized. So these sellers will come down together to create a syndicate, a kind of a organization. It is illegal in many of the countries, but it happens behind closed doors. It doesn't happen formally. They will try to protect their mutual benefit through a common understanding. So what they will do, they will create a syndicate and they will pool their resources. They will pool their resources. It means the members of the syndicate will be the owners of these companies A, B, C, D and E, and every decision will be taken by the syndicate for everybody's mutual interest. They will pool their output and they will give it to the syndicate, and the syndicate will determine in which market the goods will be sold. Alright, if suppose demand is increasing in Delhi, so they will all the firms will pool in their resources and more goods will be sold in Delhi, because when the demand is more, the price they can sell it at a higher price. So they will channelize their goods depending on the demand in every city or in every state. Alright, so this is syndicate. Organized. Now in case of syndicate, what they do, they don't fix the price. Wherever the demand is more, they will sell more. Where the demand is less, they will sell less. It means if suppose this is Delhi and this is Bangalore, here the demand was more. Here the demand is less. But if suppose the supply here, where the demand is less, here there is more supply. So what they do, they will channelize the supply from this market to this market to sell at a higher price. They are not fixing the prices, they are taking benefit or taking advantage of the demand. In case of organized oligopoly, it is very closely related to syndicate oligopoly, but only thing is they are even more powerful. They end up forming what is known as a cartel. CARTEL, cartel. What they will do, they will again form a syndicate A, B, C, D, E. They will form a syndicate and they will pool their output. But not only they will pool their output, they will try to artificially fix the prices. Now let's suppose say in Delhi and in Bangalore, if the demand is more in Delhi, what they will do, they will artificially create more scarcity in Delhi. They will pump less supply in Delhi so that demand remains same. Supply comes down, supply curve shifts to the left. What happens? The price will increase. So they can end up selling at a higher price, right? So they will artificially control the price through their output decision. In syndicate, the demand, wherever the demand was more, they were selling at a higher price. Wherever demand is less, they are selling at a lower price by pooling in their resources. In case of organized, they are trying to squeeze the supply so that they can unnaturally or artificially increase the price to exploit the consumers. The only difference is that between organized and syndicate. An organized oligopoly is even more powerful than a syndicate oligopoly. They both form part of a collusive oligopoly. For example, Organization of Petroleum Exporting Countries. Many a times they ask you, OPEC. OPEC countries produces 60 to 70% of the global oil. Saudi Arabia, Kuwait, Bahrain, these countries. Now what they do, every country is given a quota to produce. If any country produce more than the given quota, there is a penalty. If they produce less than the given quota, there is no penalty, because you are producing less. In the international market, the price of oil will go up. So whenever they will see that the price of oil is falling down, they will artificially squeeze the supply so that they can push up the price of the oil, crude and natural gas by 10 or 15% or 20% also sometimes. So what will happen? The price will increase. What happened recently in this year in March, due to lockdown and everything? March, no, it happened in in the mid of April or somewhat that time. The futures, crude futures, the price of crude futures became negative. It went down to negative. It means if you are buying, company will pay you. It has never happened in the history of the world. Why? Because the demand has significantly fallen down and the supply was so much, there was not enough storage to available with the oil companies to store the oil. And to construct new storage, it will involve capital cost. So what they did, they cannot just throw away the oil, because if they throw, they will cause environmental damage. So it means they have produced so much of oil, they have no storage capacity. So they said that whichever company wants to buy oil from us, buy it for free. It went to negative. Can you imagine? It has never happened in the history of the world, but it has slowly again started to increase. Why? Because they decreased the supply, started to decrease the supply, so the price started to come up. So this is known as cartelization. All right, cartelization. Clear? I hope uh, it's all clear to you people. One more thing, many a times student ask me, sir, what is the difference between monopolistic competition, all right, and monopolistic market, or you can say, and monopolistically competitive market? There is not much difference. Only thing is, I've told you if there are 2 to 10 sellers it's an oligopoly, but what if there are only 15 sellers, or if there are 12 sellers? Do you think the entire nature of monopolistic oligopoly market will change? No. So what happens here, if there are 11, 12 or 13 or 15 sellers, it will have very similar characteristics to oligopoly. But since there are more than 10 sellers, I will call it monopolistic, or rather we call it as monopolistically less competitive market. But when there are 100 sellers, 200 sellers, we call it monopolistically more competitive market. This was asked about the toothpaste industry in India. You see, toothpaste industry in India is monopolistically more competitive, because if you see during 90s and 80s and 90s, there were around, you know 12 or 13 companies which were selling toothpaste in India. So it was not an oligopoly, it was a monopolistic market. Before that, it was more less than 10 sellers, so it was oligopoly. But it ended up becoming monopolistic market. But since there are 13 or 14 sellers, some sellers will have dominant market share. So I cannot call it purely as an oligopolist market, because there are more than 10 sellers, but we cannot call it as a monopolistic market because there are more than 10 sellers. All right, clear? We cannot call it as an oligopoly market because there are more than 10 sellers, but we cannot call it as a monopolistic market also. Why? Because some dominant sellers are present. So what do we call it as? We will call it as monopolistically less competitive market. But today there are more than 200 firms producing several brands of toothpaste. So the same industry today has become monopolistically more competitive market. Clear? That is the difference between monopolistically less competitive and monopolistically more competitive market. So I hope this revision has helped you. All right. So uh, if there are any queries or anything, we'll see when whether a class can be arranged or not. But please remember that revision class will not help unless you have revised yourself. The meaning of revision doesn't mean that for 3 months you have not studied anything. Okay, now sir is giving revision, let's go and sit in the revision class. You may understand some of it, but not completely. Revision means you have done your homework, you have studied it once or twice, a couple of times, and then you go through the revision classes. So since this is a revision video, what I suggest you first study yourself and then you see this revision video. All right, clear? So, and since I'm saying this in the end of the video, by this time you would have already seen the video, so there is no sense in it. But anyways, if you have not understood anything in this video, you go back and see the original, because this is a revision, so I have squeezed it, but to a lower time period. You can see the detailed video when I had covered this chapter. All right, go through the notes and then see the revision video. And the quick revision note, some students were asking, sir, is it enough to only study? See, that's a quick revision note. That is for a last minute revision. So I suggest you keep that quick revision note next to your bedside, and every day for 15-20 minutes, half an hour before going to bed, you go through it. But it's not going to replace the class notes. So it will only help when you have gone through a couple of times through the class notes, and then you can revise from the quick revision note. And some students were also asking, sir, how many questions will get quick revision note? Uh, I can say with the fairly certain, in a fairly certain way, that close to 70 to 75 questions, including both business economics and business commercial knowledge, you'll get straight away from quick revision note. But that is meant for revision, trust me. All right. So take care. See you. Bye bye.